Today we're looking at the cryptocurrency phenomenon, okay? The question is this: why has cryptocurrency culture become a systematic FOMO exploitation mechanism instead of investment opportunity? And why does this system create financial speculation addiction disguised as technological innovation? Okay? We've done extensive research and discovered that crypto marketing isn't designed for legitimate investment. It's designed to create compulsive trading behaviors through get-rich-quick manipulation disguised as financial revolution. Most people think cryptocurrency is about financial innovation and investment opportunity. You buy digital assets, participate in the future of money, potentially achieve life-changing returns, and escape traditional financial system limitations. Revolutionary technology that democratizes wealth creation. But that's not what this is about. This is about the systematic conversion of normal saving and investment behaviors into high-frequency speculation addiction that generates trading fees and platform revenue regardless of user outcomes. Let me tell you what the research reveals. Cryptocurrency traders lose money 80% of the time, with average annual losses of $1,611 per active trader. But despite consistent financial losses, crypto participants spend 4.3 hours daily consuming crypto content, check portfolio prices 67 times per day, and report higher stress levels than traditional investors, while maintaining optimistic expectations for future gains. This isn't investment failure, this is addiction creation success. Here's what's really happening. The cryptocurrency economy discovered that rational investment behavior is bad for platform profitability. Once someone develops disciplined investment habits, they make fewer transactions and generate less trading fee revenue. But if you can convince them they might miss explosive price movements, you create users who trade constantly, regardless of outcomes, generating maximum platform profit through transaction volume. The business model is sophisticated. Unlike traditional investment platforms that profit from long-term user success, cryptocurrency exchanges profit from user activity regardless of user profitability. Companies make more money from frequent losing traders than from occasional winning investors. Marketing emphasizes opportunity scarcity rather than risk management. The entire system benefits from keeping users actively trading, not helping them achieve sustainable investment returns. This isn't accidental market volatility. This is deliberate speculation addiction using techniques borrowed from casino psychology. Fear of missing out cultivation through success story, amplification. Price movement urgency that creates compulsive checking behaviors. Social proof manipulation that makes speculation appear normal investment activity rather than high-risk gambling. The research shows that crypto traders dramatically overestimate their probability of success and underestimate the psychological impact of constant price monitoring. People aren't trading cryptocurrency because they understand blockchain technology or have rational investment strategies. They're trading because platforms have learned to create gambling-like engagement that bypasses traditional investment decision-making processes. Consider how cryptocurrency culture actually operates in practice. Instead of promoting long-term value accumulation, crypto communities celebrate rapid price movements, promote get-rich-quick stories, and encourage constant market monitoring through price alerts and social media engagement. This creates speculation pressure that never ends, because price volatility can create artificial urgency indefinitely. But here's the crucial point. Price obsession creates trading compulsion rather than investment discipline. Crypto traders feel pressure to act on every price movement to avoid missing potential gains. They buy during upward trends to participate in momentum. They sell during downward movements to limit losses. They constantly research new projects because established cryptocurrencies might not provide explosive returns. The crypto culture creates artificial investment requirements that wouldn't exist without constant exposure to volatility and opportunity marketing. This is why cryptocurrency often creates more financially stressed but not more wealthy participants. Users understand they have access to potentially massive returns, but realize most trading decisions result in losses. They know they're probably overtrading, but can't calculate the true cost because emotional decision-making replaces rational analysis. They want to achieve crypto success stories, but fear that reducing activity will cause them to miss the one trade that creates life-changing wealth. The social media amplification amplified these dynamics exponentially. While traditional investment advice emphasized patience and diversification, crypto content promotes constant engagement through price predictions, technical analysis, and success story sharing that creates psychological pressure to trade frequently rather than invest systematically. The early adopter narrative provides perfect cover for this speculation manipulation, even though no evidence supports the idea that frequent crypto trading creates better returns than traditional investment strategies. But the narrative justified both constant trading and acceptance of significant losses by suggesting that cryptocurrency represents a wealth transfer opportunity that requires active participation to capture. This business model obscures the reality that most crypto success stories involve early platform adoption or lucky timing that can't be replicated through technical analysis or increased trading frequency. Instead of helping people develop disciplined investment approaches, crypto culture encourages speculation behaviors that generate platform revenue while destroying user capital. The blockchain education industry represents the ultimate expression of this FOMO exploitation. Trading courses and technical analysis programs suggest that market success requires comprehensive cryptocurrency education through expensive training programs and trading system purchases. This framework transforms normal investment losses into educational deficiencies while creating spending obligations on trading education that rarely improves actual outcomes. But research on investment success factors shows that people who use dollar cost averaging and hold diversified portfolios report higher long-term returns than those who engage in active cryptocurrency trading. Yet, speculation-based crypto marketing has become the dominant approach because it generates maximum platform engagement and transaction revenue regardless of user profitability. The crypto addiction itself becomes a recognized behavioral phenomenon. Traders develop psychological dependence on price monitoring that prevents them from focusing on productive activities. They become chronically anxious about market movements and financially dependent on speculative outcomes that interfere with career development and relationship maintenance. The crypto relationship crowds out practical skill development, career advancement, and stable wealth building. This creates what behavioral economists call speculation fatigue, psychological exhaustion caused by constant price monitoring and emotional trading decisions. Cryptocurrency culture, designed to provide financial opportunity, creates people who feel constantly stressed about market movements and perpetually worried about missing profitable trades. Technology intended to democratize finance creates anxiety about volatility and pressure to trade continuously. But the industry protects itself from criticism by pathologizing resistance to crypto speculation. If someone questions the value of constant trading, they're exhibiting traditional mindset that misses revolutionary opportunities. If they want to focus on stable investment strategies rather than volatile crypto markets, they're showing risk aversion that prevents wealth creation. Criticism of crypto culture becomes evidence of innovation resistance requiring blockchain education. The most sophisticated manipulation involves reframing gambling behavior as investment strategy. High-risk speculation is marketed as disrupting traditional finance rather than engaging in casino-like behavior with life savings. Emotional trading decisions are promoted as seizing market opportunities rather than making impulsive financial choices based on fear and greed. The disruption framing bypasses risk management systems that would recognize crypto speculation as gambling rather than investment. The cultural effects extend beyond individual trading decisions. Society has become financially dependent on speculative thinking while accepting extreme volatility as normal investment behavior. Traditional patient wealth building is seen as missing opportunities rather than prudent planning. Ordinary risk management is viewed as limiting mindset rather than responsible strategy. Natural preference for stable returns is categorized as outdated thinking rather than practical wisdom. This crypto colonization of investment culture undermines traditional wealth building behaviors. Families allocate emergency fund money to speculative trading rather than maintaining financial stability. Communities compete on crypto gains rather than supporting practical financial planning. Educational institutions promote blockchain innovation without teaching the gambling psychology and addiction potential involved in cryptocurrency speculation. The economic system has been infiltrated by crypto ideology that treats speculation as investment and volatility as opportunity. Businesses accept cryptocurrency payments to appear innovative while exposing themselves to price risk. Financial advisors recommend crypto allocation to meet client expectations rather than focusing on proven wealth accumulation strategies. Even retirement planning and long-term investment advice promotes crypto thinking through alternative asset allocation rather than fundamental wealth building principles. Financial education emphasizes blockchain technology and market analysis rather than basic compound interest and diversification strategies that actually create financial security. This crypto colonization generates enormous platform profits while systematically weakening individual capacity for patient investment, risk management, and stable wealth accumulation. The cryptocurrency economy has successfully convinced people that speculation is superior to investment discipline, creating a generation of compulsive traders rather than patient wealth builders. The most insidious aspect is how this system disguises addiction creation as financial education. Traders are told they're participating in financial revolution by engaging in high-frequency speculation, but they're actually surrendering financial stability to volatility exposure that rarely produces sustainable wealth. They're encouraged to think about opportunity while being discouraged from recognizing that constant trading often prevents the capital accumulation required for actual financial success. The research shows that people who use traditional investment strategies with crypto allocation limits often achieve better risk-adjusted returns than those who engage in active cryptocurrency trading. But this evidence is suppressed or reinterpreted through frameworks that protect the crypto industry's speculation promotion agenda. Think about the economic incentives. A cryptocurrency exchange that helps someone develop disciplined investment habits loses trading fee revenue. An exchange that creates constant trading activity through FOMO marketing generates maximum transaction fees regardless of user outcomes. Which approach do you think gets reinforced by platform design, marketing investment, and revenue optimization? The cryptocurrency economy has created a society of speculatively engaged but financially unsuccessful traders who can recognize market opportunities but can't manage risk effectively, understand blockchain technology but lack investment discipline, access revolutionary financial tools but build no stable wealth foundation. The psychological manipulation operates through sophisticated addiction mechanisms that most traders never recognize. Platforms use what psychologists call variable ratio reinforcement, the same technique that makes slot machines addictive, to create compulsive trading behaviors. Occasional wins among frequent losses create dopamine responses that strengthen trading addiction rather than encouraging rational risk assessment. This psychological conditioning extends to every aspect of crypto culture. Price alerts interrupt daily activities and create urgency around market movements. Social media algorithms amplify extreme price predictions to generate emotional responses. Community forums celebrate risky trades and dismiss conservative strategies as weak hands. The crypto addiction operates through sunk cost escalation, increasing investment in losing positions rather than accepting losses. Traditional gambling addicts chase losses by betting more money. Crypto addicts chase losses by researching more projects, learning more technical analysis, and increasing trading frequency. Consider the specific techniques used to maintain trading addiction. Limited time offers that create artificial urgency around new project launches. Whitelisting systems that make crypto access feel exclusive. Staking and yield farming programs that lock up funds while promising returns that rarely materialize. The most sophisticated crypto platforms use behavioral analytics to optimize addiction maintenance. They track trading patterns and engagement metrics to identify users at risk of abandoning crypto trading, then deploy targeted retention tactics. Heavy traders who show reduced activity receive platform bonuses. Users demonstrating loss aversion get educational content about diamond hands. Traders showing withdrawal behavior receive community status upgrades. Cryptocurrency culture has created what amounts to a financial cult, where questioning speculation strategies results in community ostracization and identity challenges. Unlike traditional investment communities that celebrate risk management and consistent returns, crypto communities punish conservative thinking and reward increasingly risky behavior through social status allocation based on speculation boldness rather than financial prudence. The speculation normalization operates through what economists call narrative economics, the use of compelling stories to justify irrational economic behavior. Crypto culture promotes stories about early Bitcoin adopters, DeFi revolutionaries, and NFT millionaires that create the impression that massive speculation gains are normal outcomes rather than statistical outliers that represent tiny percentages of all participants. These success narratives explain why crypto communities focus intensively on exceptional outcomes rather than typical experiences. Stories about life-changing gains from altcoin investments receive thousands of social media interactions, while posts about steady losses and gambling addiction receive minimal engagement. Communities want to amplify evidence that supports continued speculation while suppressing information that might encourage more conservative financial behavior. The crypto economy also exploits what psychologists call recency bias, the tendency to overweight recent events when making decisions. During bull markets, recent gains create overconfidence that leads to increased position sizes and reduced risk management. During bear markets, recent losses create desperation that leads to increasingly speculative investments in hopes of recovering previous highs. Both market conditions create irrational decision-making that benefits platforms through increased trading activity. But perhaps most insidious is how crypto culture has normalized financial behaviors that would be recognized as gambling addiction in traditional contexts. checking prices multiple times per day, borrowing money to fund trading positions, hiding trading losses from family members, and prioritizing market monitoring over work responsibilities. These behaviors indicate problem gambling when applied to casinos, but are celebrated as dedication when applied to cryptocurrency markets. The cryptocurrency economy profits by convincing people that speculation addiction is financial sophistication, rather than recognizing that FOMO exploitation often represents the systematic destruction of rational investment decision-making for platform profit maximization. This isn't financial innovation. This is systematic addiction creation, disguised as investment opportunity. The cryptocurrency industry profits by converting disciplined savers into compulsive traders who generate transaction revenue indefinitely, while rarely achieving the financial success that speculation promises. But perhaps most damaging is how this system has convinced an entire generation that speculation is investment strategy, rather than recognizing that FOMO exploitation represents addiction engineering designed to maximize platform profits rather than user outcomes. People struggling with crypto trading losses, constant price monitoring anxiety, and inability to focus on productive activities are told they need better market analysis skills, rather than recognizing they're responding rationally to platforms designed to create gambling-like engagement. The cryptocurrency industry profits by treating symptoms of speculation addiction as educational deficiencies, requiring more trading system purchases. Consider what happens when someone realizes they've lost thousands trading cryptocurrency based on social media advice and technical analysis, but can't stop checking prices because they might miss the next rally. Traditional financial advice focuses on market education rather than recognizing the behavioral manipulation designed to create this exact compulsive trading pattern. This crypto normalization of speculation behavior serves powerful platform interests. Instead of questioning financial systems that profit from user overtrading, people focus on improving their analysis skills rather than questioning why participating in financial innovation requires constant transaction activity and emotional decision-making. The cryptocurrency economy has successfully convinced people that their trading losses are educational experiences rather than systematic speculation, exploitation. That their anxiety about missing opportunities indicates proper market engagement rather than addiction symptoms. That they need more trading activity rather than disciplined investment strategy and risk management. The ultimate irony is that cryptocurrency culture creates the very financial stress and poor decision-making it claims to solve. By promoting get-rich-quick thinking over patient wealth building, it undermines the disciplined investment behaviors that actually create both financial security and life satisfaction. The end result is a population of speculatively active but financially unsuccessful traders who can identify market trends but can't manage emotional decision-making, recognize technological innovation but lack practical investment skills, access revolutionary financial tools but build no sustainable wealth accumulation habits. They've been taught to optimize opportunity recognition rather than develop risk management, to trade frequently rather than invest patiently, to chase volatility rather than build stable financial foundations. The cryptocurrency economy has succeeded in convincing people that patient investment is missed opportunity, that stable returns are insufficient gains, and that speculation is sophisticated financial strategy. It has monetized FOMO, commercialized volatility, and transformed investment education into trading addiction, while systematically eliminating the patience and risk management that actually create sustainable wealth. And this system will continue expanding, because speculation generates platform revenue, while investment success doesn't require ongoing platform engagement. Disciplined investors make few transactions and consume minimal content. But speculative traders generate maximum fees through constant activity driven by volatility, anxiety, and opportunity fear. Does that make sense, guys? Okay?